those of you who don't, we are, here is Mr. Brent Gritton, One America Home Office, Regional Vice President, or whatever we call you, Guru. The floor is yours.
Hi, man. Thank you. Good morning, everyone. It's great to be here as always. Really looking forward to this session because, as Dennis just mentioned, that's exactly how it went down. This was, a couple weeks ago, and brought it up, and I'm a huge believer in it. I practice this in my own life. I was first introduced to it in 2014. And before I share my screen, I want to just give you kind of some almost full disclosure, if you will. So, many of you have heard me talk about wealth building cornerstones and the impact of it and the power of it and how it changed my practice and all of those things. And so what I'm about to tell you today is not a different system that trumps WBC or replaces it or, whatever. In fact, it actually goes completely hand in hand. And what I was sharing with Dennis is oftentimes, I would say from those 3 years of production, 14, 15, 16, if I had to put a percentage on it, it would be at least 90%. At least 90% of that business written was a combination of WBC and infinite banking. And it would just depend upon what strategy was being, or what conversation was being led with, and which one was then hey, this is going to be something that we're going to talk about perhaps during underwriting and keeping the momentum going. Because what you're going to find here is if someone is purchasing whole life insurance and adding it to their personal economy and implementing infinite banking throughout their lifetime, when they get to retirement at some point in time in the future, by default, they are able to execute on some of the options that Wealth Building Cornerstones teaches people. All right. So they go hand in hand. And on the flip side, if someone, purchases whole life insurance with the idea of, in conjunction with my other assets, this is going to give me options to create increased income when I retire. By default, as they're still going up the mountain, as they are still working, they can utilize the cash value and start executing on some of the IBC or infinite banking principles. So they truly go hand in hand. So I don't want anyone to hear, oh, well, here goes Brent talking about something else now. What's going to be kind of the flavor of the month or something like that. Because it's not that at all, but I recognize that, perhaps someone may be thinking that. So let's dive into it. Let me share my screen here. And here's our agenda for today. So we're going to do a brief little IBC overview. I picked out kind of four main things that I think, in conjunction with what Dennis went over the last time y'all were together with some training, kind of that next step, that next progression. These are all conversations that I would have with the client inside of either meeting 1 or meeting 2, depending upon how it was flowing. Also, there will likely need to be follow-up sessions to this, because as Dennis said, it is for many people, it is a complete paradigm shift in the way we go about thinking of our personal finances. All right, it's completely against the grain, not just because of the product that ends up being the best tool to execute on these strategies, but because of the idea of, I'll just give you one real quick. When paying interest, most of us would think paying the least amount of interest is the best possible thing for us. Like, interest is bad. We shouldn't pay interest. But if I told you, well, what you should be changing that thought process to be is you should pay the maximum interest. You should pay as much interest as you possibly can. Initially, someone's going to say, well, that makes no sense. That goes against everything I've thought. And if we just stopped it right there, I understand that. But if the idea was going to be all of this quote unquote extra interest that you should be paying was coming back to you and your personal economy and your family, might you have a different viewpoint on that? Perhaps. So it's all about really kind of getting deep with this, pulling back the covers and recognizing, what I thought to be true about finances perhaps isn't always the case. All right. So this is a very deep process as well. Okay, so we're going to go over just a brief overview. This idea of we finance everything we buy, whether you think you are or you aren't, we finance everything we buy. Why life insurance? Why does the act of banking, the process of banking, why is it best utilized through participating whole life insurance with a mutual company? Okay. Some of the loan features when we do start executing this, and then I'm going to take you through a brief example of this idea of paying more interest. So the first thing from an overview perspective, I want to just hold up a few here. I just snagged a few off of my shelf. So there are 1, 2, 3, 4, 5. There are 7 books that I'm holding right now. All right, 7 of these that are all around IBC. The gold standard right here, Nelson Nash, Becoming Your Own Banker. This is where it all started. All right, Nelson is the one that gets all of the credit for coining this thought process, this way of thinking, the way of recognizing that everyone's biggest need throughout their lifetime is through financing rather than anything else. Now the cash value whole life insurance has been around way before Nelson started this, right? In fact, his personal story, I'm not going to ruin anything, but his personal story was at a time in his life when he recognized, oh my gosh, I have all this cash value sitting over here. Might this be impactful to me in some of my life circumstances right now? So he is the one that gets credit for kind of coining this phrase, although the utilization of cash value has been around prior to that. So I show you all of those to say this: you are going to need to dive into this. You are going to need to put in time and effort, and there are so many resources out there to study this, to learn this, to watch videos on YouTube, read books, continue to do self-study. This is not a, hey, I listened to Dennis talk one time and Brent talk one time, and now I'm totally on board and I want to go talk to clients. You are going to have to, really spend some time with this. But I promise you, when you do, you will come to the realization of how impactful this can be for individuals and families and businesses and everyone inside of our community. Okay. Now, and that's kind of my kind of disclosure piece of it and overview, if you will. I want to get right into it. Or go ahead. Someone have a question?
Hi, Andrea. This is Mitch with US Bank.
Yes, hi.
Yeah, yeah. You have a question?
No, I think that was a side
Okay.
deal.
Okay. All right. So let me first get into it this way, because I think this concept, this idea here, really strikes with a few people. So when I make the comment, we finance everything we buy, I'm going to go out on a limb and say some of you are probably thinking, no, or I don't understand what he means by that, because I either myself or I have clients that pay cash for everything because they hate financing things. All right, so let's just take a look at an example here. Let's say that this line right here represents $0. Okay, and really inside of our economy, there are typically two main ways in order to purchase goods and services or something that we want to exchange money for, right? And the first one is going to be cash. All right, so let's look at if someone is using cash to purchase things, what does that look like? Well, in order to pay cash for something, you first have to have what to do that? Cash, right? Whether this is cars or a new TV or whatever you're going to do, vacations, in order to have the cash for it, you first need to save it. Can we agree on that? Okay, so we get to here and then we say, okay, I've got enough money for my vacation. I have enough money for my car. I have enough money, whatever it might be. So we take this money out of our savings account, right? And we exchange it for whatever that product or service was. And now we are thus back at $0. Now, assuming that this is going to be a repeatable purchase, like let's say cars, or you take a family vacation every year, or whatever it might be. If you want to be able to pay cash for it the next time, what do you need to start doing? Yeah, you have to start saving back up, right? So you save back up, and then you get to this point and you say, all right, I got everything. And at the end of the day, this process just repeats itself until at the end, you are still at $0, right? Now, what would the flip side of this be? The flip side would be, if we're not going to pay cash, we're going to do this on credit, all right, which is where most people in our society today go, right? So how does that look? Well, instead of saving up the cash first, you make the purchase, and then over time, you're going to pay that loan back and continue to do this, right? Now, I think this part is pretty self-explanatory. We recognize how that happens, but here's the problem, okay? On the credit side of things, all right, we actually, you know what? Let me go to cash for a second. On the cash side of things, let's look at this moment right here at the top, where we decide to exchange our $10,000 for XYZ purchase, all right? Although we get that, we get that product, right? What we have now given up the ability and the right to do is to earn interest on this money moving forward. Have we not? Because think about it, if we have this money inside of our account, even if it's earning very little interest, whatever interest it was earning, if we take that money out, we are no longer having the ability to earn interest on those dollars. All right. And this is known as lost opportunity cost. Okay, lost opportunity cost applies to everything that we do, every decision we make, because it simply comes down to, what else could I be doing? Right now, the lost opportunity cost of you all investing 40 or an hour of your day to be on this session is, what else could you be doing? Because you could be doing something else. All right, so that's why we need to maximize our time and make sure that this was good exchanging of time for value. All right, but in the finance world, it simply comes down to, what could I have been doing? I could have been investing that money. That would have been my lost opportunity cost. I could have been continuing to earn interest on those dollars, and that would be my lost opportunity cost. So even when we are paying cash for something, we are giving up the ability to earn interest. Okay, now on the credit side down here, not only do we have the lost opportunity cost on each one of these payments, but now we're going to be charged that little thing called interest. And we have interest on each one of these payments. Okay, now hear me. It's not that I'm saying, you know, is it possible for someone right from day one to never buy things on credit? Probably not, right? Because even, again, in that cash perspective, you have to have the cash first in order to do that. Okay, now looking at the two, I think all of us would probably agree that if we were to choose one of these options as being the most financially sound stewardship of our finances, paying cash is probably the best route to go, because it ensures that, you would think it lends to the fact that we are living inside of our means, not overspending, so on and so forth. But again, I've had clients that are cash purchasers, especially of vehicles, and they'll be looking around at what vehicle that they want. And I would ask them, you know, can you afford that? And they say, oh yeah, absolutely. I've got, 30 grand sitting over here. The true definition of them being able to afford it is if they can replenish that stock, if they can replenish that reserve in order to do it again the next time. All right, so this is all a cash flow situation. So the reason I say we finance everything we buy is because we are either paying interest and having lost opportunity cost on top of it, or we are giving up the right to earn interest. And thus, we finance everything we buy. In fact, when you think of financing, if you're going to finance something, what comes to mind? Like, what do you associate with finance? Go ahead and unmute yourself and just shout some things out. Let me give you some. How about interest?
Interest payments.
Yeah, interest and payments. Okay. Again, look at our cash example up here. Is there interest in a negative connotation tied to that? Well, yes, there is, because of everything we are giving up on earning of those dollars. Is there still a payment associated with this if someone is truly going to have this cash operation in their life? And I would say, yes, there absolutely is, because we have to fund the stair step all along the way. All right, so we really need to be changing our thought process to think of the ins and outs of money and the cash flow perspective. And this is where the process of infinite banking is not a product. Infinite banking is not a solution per se. Infinite banking is a process, and it is replacing, it is controlling the banking function throughout our life. Okay. Now, we're going to revisit this here in a second, but let me move on and lead into this idea of, it's no secret at this point, whole life insurance, specific whole life insurance, is the best vehicle to carry out this process. But we first have to start with a little bit of why. I'm not going to get into the structure so much on this call, although that's very important, but because Dennis talked about it a little bit on the last call with base and PUA and so on and so forth, we can revisit more in the future if we need to. But I want to take you through just a little bit of, I'm going to call this the 10-minute lesson on life insurance. Okay, and here's conventional wisdom, the way most people go about thinking of things. And think of either yourself or clients that you have been around. Let's say someone says or has the thought one day that, you know what, I need some life insurance. All right, not very common, right? But let's say that people just wake up thinking, man, you know what, I need some life insurance. And through their own self-discovery, or they're read something on the internet or pulling a number out of thin air, let's say that they decided they need $500,000 of insurance. They need $500,000 of death benefit. Okay. Now, where's our first reaction or thought process go? Well, now it comes down to, where can I get the biggest bang for my buck, right? Where can I get the $500,000 that I feel that I need and pay what for it? The least amount, right? So in the life insurance world, we all recognize that from a pure cost per thousand perspective, the minimum amount that they can pay for that is going to be down here. And what product is that known as? That is known as term insurance, right? So here are the term insurance premiums. Okay. Now, who determines the premium amount for that term policy, for that $500,000 of death benefit? The insurance company, right? The insurance company is going to set that. They're going to say, hey, based on the fact that you're a male and you're overweight and you're this age, blah, 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 here's your corresponding premium. Okay, they price all of this out in order to be able to be profitable, right? So there's term insurance, pretty self-explanatory. Now, the next piece, though, as many of us know, we have right about in here, we have whole life insurance, anywhere 12 to 15 times typically higher than that of term. Okay, so why is it, or first, let me go, who sets the premium amount for whole life insurance? Also, the insurance company, right? Same thought process. It's all through actuary, all recognizing here's what we need to charge based on the law of large numbers. Here's what's going to be paid out for us to be able to be turning a profit and staying in business. Okay. So the first piece is, why is it that someone would pay 12 to 15 times more for that same $500,000 of death benefit? This is no different than when you are looking for a new TV and you say, you know what, I'm going to get a 55-inch TV or a 65-inch TV, something awesome. This is going to be sweet. You go in, you're looking at TVs, and all of a sudden, one 65-inch is $1,000 and another one is $5,000. Why on earth, for the same 65 inches, would I pay $4,000 more? That thing better come with some darn good features, right? The picture better be clear. It better have a higher refresh rate, so on and so forth. We understand that. So there are a lot of benefits with whole life insurance that would drive someone to wanting to accomplish or to satisfy that $500,000 death benefit need with a quote unquote more expensive today product. Okay, now we're not going to get into this. Maybe it was WBC, maybe it was something else. That's not the point of this conversation. So whole life insurance right here in the middle. Okay, but here's what most people don't realize is, for that same $500,000 of death benefit, there is also a maximum amount that you can pay for it. And now let me ask you this, who determines the maximum premium for that $500,000?
Government.
Bingo. You know, it's so funny. I'll be doing this lesson with a client early on, and they'll say, well, do you determine that maximum amount? And I kind of laugh and say, I wish I was the one that could determine that, because I'd be putting in a whole heck of a lot more than I can right now. All right. So yes, it is not the insurance company that determines this. It is the government. It is the IRS. Now, here's the question. Are they setting a maximum amount because they want us to be well diversified, and they're looking out for us and our best interest and all of those sort of things? Is that why they cap us out? Or perhaps is it something that starts to be negative for them? Yeah, we all know the answer to that, right? So this maximum line, this is, you can see this, I wanted to leave a little bit more. This is our MEC line. This is our modified endowment contract. When this came out, here's essentially what was happening. People were recognizing all of the tax benefits of utilizing cash value inside of their policy, and then the death benefit passing on tax-free. So people were selling off large chunks of stock and acquiring whole life insurance, the smallest amount of death benefit that they could, and stuffing it full of cash. And the government kind of come out and said, whoa, wait a minute. We recognize what's happening here is this is more of a tax avoidance plan rather than purchasing life insurance for the reasons that people typically purchase life insurance. Therefore, we are going to put a maximum amount on this for a corresponding death benefit. This is section 7702, okay, for the corresponding death benefit. So what we're trying to do through the proper structure of infinite banking policies to then execute on this process is we are trying to structure a policy that is right up beneath that MEC limit without crossing it. So here's where conventional wisdom completely gets flipped upside down. Remember, we started this thought process with, all right, now that I need 500,000 of death benefit, where can I pay the least amount of premium in order to get the maximum amount of coverage? And through structuring policies through infinite banking this way, really what we're doing is we're trying to pay the maximum amount of premium for the smallest amount of death benefit. There, right from the jump, this goes against the grain of the way we think. Do we all get this?
Mm-hmm.
Right? Whether it's health insurance, car insurance, whatever, the extended warranty on your grill, right? Where can I pay the least and get the maximum? Whereas now what we're saying is I want to pay the maximum and have the least amount of death benefit. Okay, now I also will, let me pause just for a second. This is not undermining the importance of death benefit for people. Okay, anyone that's going to tell you that the death benefit is not important, they're wrong. Okay, because it is. Now, what they're likely saying, if we peel that back a little bit further, is inside of that particular policy, they're wanting to have the smallest death benefit for the maximum premium. But if you look at that individual or that family's total death benefit at play, there's likely a boatload of term insurance as well, or multiple policies that add up into an aggregate of a proper death benefit amount. Okay, so I want to make a very clear distinction there. I'm a huge believer in death benefit, human life value for people, and maxing that out. It's just as we structure the whole life policy, maximum for cash and then utilization, that policy in and of itself, smallest death benefit, maximum cash. Okay, so let's move on. And let me pause for a second. Any questions or comments about that? Okay, so once we then structure the policy properly and we recognize that there's a minimum, a whole life premium, and then a maximum amount, and why someone might do that, why is this strategy or this thought process of infinite banking utilized through a participating whole life policy. And there are many reasons that we're going to discover, but here's one that I think illustrates it perfectly. All right, let's look at this graph here. What does that represent? Starts with a C, ends with ound. It's a compound curve, right? Compound curve. Now, going back to that stair step analogy, if someone is saving up, boom, they got their cash amount and take money out, doesn't that kind of look like this? They get here and then boom, they take it out. So then they're going to have to start their compound curve over again, and then they take it out. Have to start it over again, then they take it out. Start it over again, take it out. Isn't this essentially what they're doing?
Mm-hmm.
And in fact, the driver of compounding, we all know this, but the driver of this is time. We all only get one compound curve in our life. Okay, and we don't know how long it's going to last. All right. So one of the biggest reasons why carrying out the banking function through the vehicle of participating whole life insurance with a mutual company is for this right here. Rather than giving up all of this future wealth, remember my stair step ended at 0 here. Rather than that, here's how a life insurance policy will work. At this time here, instead of taking money out, you're going to take a loan against it, and you're going to pay it back over time. And then you're going to do it again and pay it back over time, and then again. And you're going to do this throughout the course of your lifetime. And so at the end, you are never interrupting the growth of your money. I want you to think about that for a second. Is there an account out there that you have 50 grand in, that you say, you know what, I want to go capitalize on this investment opportunity over here, or I want to buy a boat, or whatever it might be? Is there anything out there that you can take that 50 grand, utilize that money, and go and acquire that either investment or expense, and have that 50 grand in your account continue to still grow and work for you? Outside of putting something up as collateral, which is a whole different discussion, that doesn't exist. So utilizing the cash value of your whole life policy allows you to do exactly what is on the screen right here, to not interrupt your compound curve. Again, think about this. If someone how different would some of your clients' lives be if the $200,000 that they have in their 401k right now, if they could, let's say they needed a new roof, wasn't going to be covered by insurance, they're going to pay 20 grand for their new roof. If they could take money out of their 401k to put on a new roof, forget all the tax implications and all that sort of stuff. And if the money inside their 401k was still going to grow as if they did not take that money out, how many of your clients would do that? All of them, right? And here's one of the biggest things that you're going to see here in a minute, especially this idea of paying interest. What makes this go, it's a system, it's discipline. Those same clients, how many of them would take 20 grand out for their new roof and then be like, 180 is good. I don't need to replenish that. It'll grow back over time. They don't change their lifestyle at all to replenish those savings. They just let it go. And the end result of that is at some point in time in the future, when they need that money to work for them in the form of income and retirement, by default, they're left with a lot less because they were not an honest banker. They did not pay themselves back what they utilized. I mentioned to Dennis the other day, really infinite banking, one of the best ways to describe it as well. I think it is the ultimate cash management scorecard. Because when you're really doing this, there are rules associated, or what you should be implementing with accessing I'm going to say but you'll find here in a second, it is not your cash, but accessing your money come with rules attached to it. And those rules are, you do pay this back. You do pay it back with interest. and you do pay it back with more interest than what the insurance company is charging you. Okay, so it really ends up being the ultimate cash management scorecard because you always know where you were, where you have to get back to. But as we see here on the screen with continued compounding, you're constantly growing as that happens. Extremely, extremely powerful. Let's go to the next thing here for a second. So let's talk about some of the characteristics in and of themselves. All right, let's say here, let's just say that here is your cash value inside of your policy. And let's just say that you had 50 grand there. Okay, now we all recognize that in order to get $50,000 inside of your cash value whole life policy, who's funding that? Who is putting that money there? You, right? You need to be saving money first. You need to be paying premiums. You need to be capitalizing your quote unquote bank. You need to build up your reserves. Okay. But we're just going to look at an example and snapshot of time here. Let's say that there's $50,000 inside of this account. Now, here's what the insurance company will allow you to do. It is a contractual, what do I want to use? The loan feature is a contractual provision. Okay. So the insurance company will allow you to take a loan against that cash value. All right. So here is the insurance company over here. Now, how much will they give you a loan for? The insurance company will give you a loan up to 100% of your cash value. Now, we'll break this down further. The way the accounting of it is sometimes a little bit different, but all of that cash value is available for loan access. Okay. Now let's talk about the features of this loan for a second. So you say, hey, insurance company, I want a loan against my policy for $50,000. Here's the process that they're going to ask you. Rather than filling out a full application and needing to proof of income and employment and repaying all this and being able to qualify for it, here's the question they're going to ask. Would you like that money EFT'd to you, or is it an overnight check okay? That's the question. Okay, so there is no, I'm just going to put no credit check. There is no credit check required. Again, no verification of income, no, can this person afford it? What is it for? None of that. It is as simple as I would like to take a loan against my policy. Boom, here you go. Think about other vehicles or other ways that you would go about acquiring a loan. Is that in and of itself right then already a game changer? Yeah, I don't know if any of you have been through purchasing a home or a car or whatever recently, but I think you would recognize that it's completely different. Okay, so here's the next thing. The next process about this as far as a feature is there are 0 repayment terms. 0 repayment terms. Brent, what does that mean? Here's what it means. The insurance company does not care how much you pay back of that $50,000, when you pay it back. Do you pay some this month, not some the next month? Do you skip this year and come back? They don't care how much, they don't care when, and they don't care if you pay it back. You have complete control over the repayment of this loan. Now, before we come back to the why on that, let's think of it like this. If any of you have a car note outstanding right now, all right, and you miss your payment this month, and then you miss it again next month, and the next month, what's going to start happening?
Some guy's going to come take my car.
Yeah, at the bare minimum, your credit's going to start taking a ding. You're going to be getting a lot of phone calls. And if it goes on long enough, they can go and they can repo that vehicle. Why? It's because you violated the repayment agreement. You promised to pay X amount per month until that note was satisfied. With the life insurance policy loan, there are no repayment terms. You dictate how much, when, or if. Now, before we go on any further, Brent, you're telling me that I don't have to pay the loan back and the insurance company doesn't care. How could that be? Well, let's think about it for a second. Remember, at the end of the day, this is life insurance. Okay? And life insurance whole life insurance is going to come with two components: the cash value, which is where we're spending a lot of the emphasis on right now. But what else? What is the other main component of whole life insurance? Death benefit, right? So if someone passes away with a loan outstanding against their policy, it is deducted off of the death benefit. So a life insurance policy loan is the most secured loan ever. Because the insurance company knows that one way or another, either by the consumer or the client paying the loan back in the form of payments, or they're going to pass away someday and it's going to be deducted off of the death benefit. The insurance company knows they are going to get their money. That is why it is the most secure loan in the world. It is completely private because no one knows any of the details about your policy other than you, your agent, or the insurance company themselves. That's it, unless you choose to disclose it, right? Okay, this next one I want to go to is every payment that you do make is 100% liquid, available to be loaned out again. So this is actually functioning like a line of credit. But it goes further than that. Okay, because the insurance company will always allow you to access up to 100% of your cash value for loan, and we know that the cash value is guaranteed to increase. Essentially, what we have is a guaranteed increasing line of credit that we do not have to qualify for, and that we control all of the repayment terms for, and it cannot be closed out on us. How many people that have had house payments or car payments, whatever it might be, and they fall on hard times and they can't make their payments, and they call up the bank and they say, gosh, if you just give me a little bit more time to find a job, I'll be able to make my car payment. How many times is the bank gonna say, okay, yeah, no problem, just pick it back up when you can? They're not. Right? How many people, just this right in and of itself, if they bought their cars through a financing mechanism such as this, where they could stop their payment if they needed to, how many people might that help? Or a business owner that's able to maintain payroll for this time period and keep it up and not have to close shop. I mean, that the control, infinite banking comes down to two of the biggest things: discipline and control. Discipline and control is huge. Okay. Now, here's what I want to ask you. Think about this yourself. If Wella, if all of us in Wella, Dennis and everyone involved, if we were going to pool all of our money together and we were going to start offering loans to the general public that have these features, we don't care what your credit is. We don't care how much income you have. And you know what? Pay us what you can when you can. And as you do pay us, you can loan it back out again. If we were going to create those characteristics on the loan service that we provided, how much interest would we charge people?
25%.
How much?
25.
I mean, yeah, 25. Great. Yeah. The bottom line, we would charge a heck of a lot of interest, right? Because we're taking a lot of risk. We're taking a lot of risk with that. All right. So I guess another way to say this is, if we're saying that these terms are so favorable that we would charge people a lot of interest for them, then that means there's value here. Now, what does the insurance company charge? And hear me on this, because sometimes this message can get a little cloudy. The insurance company does charge you interest, a straight interest payment for this. All right, now it depends upon carrier, but is essentially, I'm just going to use a round number. The interest that they're going to charge is about 5%. Okay, so it means if you take this loan and you pay it back over a period of time, you will be paying an interest charge to the insurance company. Okay, now actually, I don't even want to go down that road yet. They're going to charge you interest for that, but Dennis just kind of chuckled and said, heck, if we were going to offer these loans, we charge people 25% because of all the value there. So the fact that the insurance company is charging us 5%, do we immediately think that, you know what, gosh, that's a pretty darn good deal? I think so. Okay, now let's just look at it. Let's just do an example here, and let's look at a 10-year analysis. Okay, and I'm going to use some updated numbers versus, but I think it proves another point here. Let's do this. So if we took this $50,000 loan, okay, and let's say we were going to pay it back every month, even though we had the flexibility of it. If we were going to pay it back every month and we are charged 5% interest, that would be 120 months. Okay, our payment would be $528. $528 a month. Okay, so how much interest did we pay in that example? 528.13 times how many payments did we make in this example? 120, right? So times 120 is 63,375. So how much interest did we pay?
13.
Yeah, 13,375, right? Okay, everyone see that? So over here in 10 years, we paid 13,375 in interest, but we had all the flexibility. It was private, all the control, so on and so forth. 13,375 in interest. But remember, going back to the stair steps and to the compound curve, what also was happening during that 10-year time period? Our cash value was growing, right? It grows from two components. We have, I'm going to put this in quotes, we have guaranteed interest plus a dividend. All right. Now, used to always be going back a while, it used to be, just for the sake of discussion here, I would use a 5% growth rate on the cash value, but we're going to reduce that right now and still look at the message that it tells. So over those 10 years, because we had access to that cash and it was going to continue to grow uninterrupted, what happened to our cash value? 50,000, even if we didn't make a payment to it, right? Just because we're trying to isolate this. And if it was growing at 4% over 10 years, it grew to 74,000. So how much growth happened during that 10-year time period? 24,000, right? Okay, so over here we are plus 24. Okay, so here's my question. Dealing with payments and time frames and interest, why over here on the right did we only have to pay 13,000 of interest at 5%, but yet over here we earned 24,000 off of a lesser interest rate, 4 versus 5? Why did that happen?
Compound curve.
Bingo. Let's go back up a screen because of this right here. Now, I'm a stickler on language, so hear me on this. The reason the insurance company is charging us interest is because they are actually lending us their money. This is not your money. They are lending us their money with our cash value as collateral. That is why there's a maximum that we can get. But the insurance company is no different than you and I. They also have lost opportunity cost. And if they are lending us their money, it means they can't be investing those dollars and earning interest on them, right? So that is why they charge us interest to borrow their money on extremely favorable terms, because they know one way or another, they are always going to get their money back. Okay, so let me pause for a second. Here's just kind of a brief description of the power of just, I'm just going to call it the life insurance loan. We really haven't even got into the idea of infinite banking per se, but so much of it hinges upon, we finance everything we buy. Let's get our mind right with that. You're either paying interest or earning interest, or you're giving up the ability to earn interest, right? We're going to structure the policies to be the maximum amount so that we have as much cash available right here in this diagram, as much cash as early as possible to then take out that loan on these extremely favorable terms for either an investment opportunity or an expense, while not giving up the compounding growth of our money. So let me just pause for a second, and I'm going to show you an example. What questions or comments do you have? Nothing?
Come on.
Did everyone know this about the loan characteristics? Or are any of you thinking, wow, oh yeah, that's cool? Bill, go ahead. You came off mute. Oh,
I knew it because I've been reading this, but it's an absolutely wonderful thing. So I'm great to, it's good to see you actually lay this out. I like the way you were presenting this, and I can't wait to review this a few times.
cool.
But that's, yep.
Cool. All right, so now let's take it up a notch, and we're gonna end on this. So we just said that if we were to open our own financing company and offer loans like this, that we would charge a crazy amount of interest because we're taking all the risk. So we check off the box that, wow, the insurance company is offering it to us basically at a bargain to be able to take advantage of this. So we now have to then switch our focus yet again to say, you know what, there is a lot of value here, and I need to treat this value with the utmost respect, the utmost value for myself and my family. This is where the rules come into play. So I'll just tell you, with my family, rules are associated with this. When my 2-year-old daughter, when she gets to a point where she's understanding things a little bit, talk about the teaching opportunities that this is going to provide for me. Because when Lila wants something, it's not going to have to be, no, baby, I'm sorry, we don't have money. We have money. It's just, if you want that thing, you have to understand the family rules associated with it. All right. And you have to, if we borrow from our family reserves, we have to replenish it, and we have to replenish it at a higher rate, is where I'm getting into, than what the insurance company is charging me. We need to pay it back with more interest. Now, as kids are younger and they're not earning income, maybe their quote unquote payment is by doing some more chores, or as they're getting into school, earning the right grades, or, you know, allow your imagination to go with that. But here's where this has come down to from a value perspective. What I would tell you, this is a nominal rate, what I'm about to say, but if the insurance company is charging you 5, you should pay back at 10, or just something north of 5. All right, because here's what's going to happen. Let's say that you are paying back, I'm just going to use 10% for the payback just because it's easy. If you are paying back at 10%, here's what happens. 5% goes to the insurance company to satisfy them. Where do you think the other 5% goes? It goes back into your pot, into your reserves. And once it is in there, it also is immediately earning guaranteed interest and dividend. And thus, this 24,000 here in this example, by default, will be higher, correct?
Mm-hmm.
For the simple fact that we're adding more money to it. So it's very, I'm going to take you through a number example here to end. And it's very easy to come to the realization, well, yeah, Brent, of course it's going to be more. You're putting more money into it. But it comes back to, why are you putting more money into it? Because of the discipline, because of the thought process, because of the recognizing what you have available to you. All right, let's look at this example for a second here. I think this is really cool. So let's just say that, as that loads, gosh, what do we want to do? Let's just look at, let's take this same loan, $50,000. Okay, again, don't care if it's 10,000, 25,000, whatever it is, but 50,000 because you're buying, you know what? You're going to buy a boat. I was just on a lake in Tennessee over Memorial Day. I was talking to a buddy of mine that was showing me, oh, that boat's probably 170,000. I'm like, what? Crazy. boats are nuts. Insane. But anyways, let's say that you were going to take a loan for 50 grand for your boat. All right. and the insurance company is going to charge you 5% interest. And because you dictate when you're going to pay it back, let's just say that you said, you know what, I'm going to treat this kind of like a car. I'm going to pay it back over 5 years or 60 months. Okay, actually, you know what, let's go. Yeah, we'll leave it at that. You know what, let me change this to 25. I'm going to change my narrative. 25,000, we're going back to a car. Forget it. Going back to a car, $25,000 car being charged 5% over 60 months. So our payment would be $470 a month. Okay. Now let's say that you decided inside of your budget and inside of your personal economy that you could handle $470 a month. All right. So let's take this over 60. Here would be the amortization of it. All right. You'd pay back 28,000, or I'm sorry, 64,000 here. No, 28. Why is this going wrong? 5%. Hold up. That doesn't look right.
The loan balance is growing for some reason.
Yeah, I know, and I don't know why. Hold on a second. Let me clear this up. Okay, 60 loan balance. Oh, that's why I did it as a negative. Interest rate 5% over 60 months. So boom, there we go. So our payment would be $470 a month. Same exact thing here. Okay. Now here's what I'm saying. Remember, treating with value. If I told you that you should pay this back at 10%, where does your mind go? What's that going to do to your payment, your $470 a month payment?
Sounds like it's going to be much larger.
Much larger, of course. Any idea how much more? What do you think the most common answer is if you're going to double the interest rate?
Double the payment.
Double the payment. Okay, for the sake of time, I'll just get into it. So $470 a month, and you feel that that fits within your budget. So this is what you're going to do, right? Paying back at 10% is an extra $59 a month. So here's my question. Is that extra $59 a month going to break the bank? And the answer is, if it does, I would argue 470 was too large to begin with. Right? So again, it's not, and remember, whether it's 10% or 8%, an extra 35, whatever it is, we're still going to go with 10. Okay. Now here's what happens. Remember, because we have these rules associated with it, over these 10 years, I'm going to be paying this back. I'm paying back at more interest. This extra $59 a month is going to my cash value through the paid up additions rider. It's going to my cash. So at the end of this 5 years, my car is paid for, right? I paid the loan interest to the insurance company. My cash value continued to grow over those 5 years. And by just paying an extra $60 a month, I added $3,500 more to my cash on top of what it already was and what it was growing to. But now here's then the next piece of that. Once it's in there, it continues to grow forever, right? So this looking at just 60 months is too finite. What if we looked at this over the next 30 years, this one transaction for 360 months? Okay. Look at how much and then we're growing at 4% inside of our cash. We just put an additional $10,000 into our side of the ledger, into our personal economy, because we had the discipline to follow our rules of treating our quote unquote bank with value and being an honest banker. Now imagine if you do this type of concept with everything inside your life, all big ticket item purchases. I'm not talking about just running your groceries and everything through here. I'm talking about if you just isolated your big ticket items, your cars, your family vacations or future weddings or down payments on homes. If you did all of that, the lost opportunity cost that we're able to put back into our pocket, you will find will far exceed any sort of rate of return that you're going to get out there. I'm going to end with this. Imagine if this concept right here Imagine if this was an investment opportunity that happened to be a cash flowing investment opportunity, such as real estate or perhaps an oil and gas deal. What if it was the cash flow from your tenant that was paying this back, and you had your money growing inside of your whole life policy, and you had your money inside of your real estate and they were the ones paying it down for you and growing this reserve then over time? Can you start to see how much of an impact this would make? In fact, I would venture to say I could show you how starting with your money in the policy first and then loaning it out for other investment opportunities will increase the rate of return on any deal that you do. Okay. All right. So I think that is good for today. Let's call it quits with this. So we went over this idea of we finance everything we buy, right? The why whole life insurance gets utilized, why there is a maximum limit, the loan characteristics of the policy itself. All right. And then this idea, scratching the surface of this idea of paying back at a higher interest rate and what that can do for you. So let me end it there with any questions,
Brent,
comments,
I
or
have a question.
concerns.
I have a question. Can you,
Yes,
can you
sir.
hear me?
Yes, sir.
So how does the insurance company know that you're paying extra percentage back and not using that extra money to pay down principal on the loan?
Yeah, good question. So on the actually, that's a great question. On the actual and on the form, you can indicate how much is going to loan balance and how much is going to PUAs. But if you looked at here, and the situation will just be different. If this button right here, apply excess payment to loan, if I did that, the loan would be paid off about 8 months early. But then being honest with ourselves, the idea would be you continue making that same payment and they just go into all PUA, getting you to 60 months. But where that comes into is what is the MEC limit of that policy? Is there enough room available? So on and so forth. But the very simple part of your question is you indicate to the insurance company, is this principal, interest, or PUA? Good question. What else?
And then how does it affect, does the insurance company notify you when you're getting close to necking out?
No, but they will notify you if you have, and they'll say, hey, you just put in $10,000 too much. Do you want that to go through? And if so, your policy will become a MEC. And if we don't hear back from you, we're going to refund that premium so that it doesn't happen. So that's why it's important to know, hey, on this policy, I'll call it policy number 1, what is my annual limit? If it's 10 grand, I'm always going to stay, about right there. But a policy can become a MEC even if you don't violate the maximum annual amount. There's the ratio between the cash value and death benefit down the road. So you'd be able to monitor some of that stuff through policy service or have good client files with it. But the insurance company is not going to allow it to become a MEC without you knowing.
Yeah, the longer the policy is in force, it increases as far as what the max becomes.
No, once the annual limit is set, that is not going to change.
Okay.
Now it's all, again, some insurance companies do their 7-pay test differently as far as what is a material change and when does that start. But generally speaking, if this is built with a $20,000 max annual premium at the start, it's never going to increase thereafter significantly. It would only likely stay the same or decrease some.
Which makes it easier to understand why people get multiple policies.
Bingo. And it's that period of time. We in the future, we'd go through this idea of base and PUA. All of the front end expenses are associated with the base premium. All right, commissions, acquisition costs, everything associated with it. So over those first 5 years, trying to stuff it with cash as much as possible. But then after that, the base premium starts to be very, very efficient. Meaning, if I'm paying just $10,000 of base premium and I'm 6 years into my policy, likely my cash value is increasing by more than 10 grand every single time I make that payment. So let's strip out the PUAs of that policy and use them to open policy number 2, structured the exact same way, minimum base, maximum PUA. Again, it starts to get real deep with that, but great observation.
What about qualifying for that amount of insurance? They say
Another
if
great
somebody
question.
makes 50 grand a year, you can only get $1 million or whatever it is. And now you're at the limit. How do you buy more policies?
Yeah,
You
at
don't.
the end of the day, no one can acquire more death benefit than what they economically are worth.
Right.
So no, it's interesting because I will tell you that there have been many clients that want more whole life insurance than the insurance company will issue them.
Right. I would imagine. Yeah.
So what you end up having to do is there just needs to be insurable interest, right? So that's why you'll see a lot of people start, I have policies on Lila, policy on Allison, policies, all over the place that I'm the owner of, but I'm not the insured on them. That's some way how people do it. But then also at the end of the day, once you cap out, you cap out. Especially with children. One of the largest cases I did was a surgeon down in San Antonio, and it was about $300,000 of annual premium, and he wanted to do $20,000 a year on his 8-year-old son. And it was, John, we just simply can't do this. The maximum we could do, the maximum death benefit we could get through was $1 million, and that was like $4,000 of base premium. So the maximum he could do was about 12 grand a year, even though he wanted to do more. So at the end of the day, it is still life insurance, and all those rules apply.
Yeah. Okay.
Good
Thanks.
question.
Yep.
All right.
Really,
We are
really.
about 7 minutes over, so I apologize for that. I'm going to turn it back over to Dennis, and we'll go from here.
Outstanding. Really good stuff, Brent. We have it recorded. We'll send it out. You gotta watch and rewatch and read books, and we do have people that are doing this today, joint field work, and Brent is supplying us more people that are doing this across the country. And so if you get somebody interested in it and they watch an introductory video and they say, I got the concept, and bring somebody in to do joint field work with you. And so we will continue to dig into this or share examples, share success stories. Again, Leroy Mack in under the Bella umbrella. Dave Swanson is a certified Nelson Nash Institute guy. There's other guys that Brent's going to give to us, and so we will continue to dig into that, especially for those of you who are really wrapping your head around this. Good stuff. Thank you.
Thanks, everyone. Looking forward to chatting soon. Have a good one.
Thanks. Very good.